This is a brief review of cash and cash equivalents. Cash and cash equivalents are normally classified together on the balance sheet, and I think it's best that we take a look at the three different major categories which make up cash and cash equivalents. The first one being cash, which is currency in coin, that's what's on hand. Demand deposits, which are typically checking accounts, and unrestricted time deposits, which are typically bank savings accounts. Now, there's another category called a cash equivalent, and actually it's basically it consists of deposits in transit, and those are deposits that the company has collected and have sent those deposits on to the bank. So we count that as cash. Also, negotiable instruments to be deposited. In other words, those are also checks, but we just haven't gotten them together yet to deposit them into the bank, but we actually hold and control them. So from the point of view deposits in transit and negotiable instruments, what we need to do is we need to, in order to consider the cash equivalent, the entity has to be, number one, in control of those negotiable instruments, and those negotiable instruments have to be what I call depositable. As an example, as control and depositable, a deposit in transit is considered cash because we are in control of it, and it is depositable. On the other hand, an unsigned check, in other words, if somebody sent us an unsigned check or they send us a post-dated check, those checks, even though we have control over them, they really can't be deposited or honored by the bank until there's a particular point in time or the check has actually been signed. Now, we also have another category of cash equivalents, and these are called non-restricted short-term investments. We're going to spend a little bit more time on these a little bit further on in this review. The other thing that they test for, one of the things they may test for on the exam, is the fact that when the entity actually writes a check, checks written by the entity to the payee are still considered the cash of that entity until those checks are actually mailed to the payees. So if you have if you have checks that are sitting around that haven't been mailed out yet to the payees, and that amount has been deducted from your checking account and your book's checking account, the CPA would make you add that cash balance back because it's still your cash until it leaves basically your control in the mail. Now, when we take a look at cash, cash itself can be categorized into two areas. The first one being readily available, and that becomes a cash and cash equivalent. However, in some cases, cash, even though it's cash, it is restricted, and it can be restricted for a specific purpose. And typically, a specific purpose is for, let's say, a bond sinking fund where a company has to deposit so much money in a particular bank account or a checking account, and that amount is maintained over the years, and that's used to pay off let's say, a bank note or a bond. If that's the case, that amount has to be presented separately from unrestricted cash, and we also have to have a footnote disclosure. And typically that type of bank account, as an example, if it's a long-term, in effect, sinking fund, we're going to classify that not as a current asset but as a long-term asset on the balance sheet. Now, cash can also be restricted in terms of what we call compensating balances. A compensating balance is when a bank loans a entity money. There is an agreement, either it's a formal legal agreement or it's possibly an informal agreement, that there is no formal agreement per se, stating that stating that the bank from that loan balance has to keep so much money in the bank account. In other words, in theory, they can't really utilize that money. And that's for a couple of reasons. Number one, it gives the bank some additional equity cushion in case something goes wrong. And number two, since the client is restricted from using that, yet they have to pay interest on that, it actually, from the client standpoint, it creates a higher effective interest rate. And the bank, we won't go into this right now, but the bank also gets some benefits of having that cash on hand. Now, there's three different scenarios for a compensating balance. The first thing is if it's a short-term type of compensating balance, in other words, basically a year or less, and there is a legal agreement. The balance is separately reported, but it's reported as a current asset. So we have to separate that from cash and cash equivalents and report it separately. If it's a long-term legal agreement, the balance is separately reported again, but as a non-current asset. And thirdly, if there's no legal agreement, in other words, it's just kind of informal, they should keep that balance on hand, but they don't have to. The balance is reported as non-restricted with footnote disclosure. In other words, you can actually keep that in there as you can keep that as cash and cash equivalent, but you have to disclose that compensating balance, that theoretical restriction in the footnotes. Now, we're going to revisit cash equivalents just for a minute because we will still want to talk about what I mentioned earlier, short-term investments. Again, cash equivalents, as I showed them in our first slide, were negotiable instruments and deposits in transit. They also include, though cash equivalents also includes this a category called short-term investments. And these short-term investments can be considered cash equivalents even if they're not cash, but they are readily convertible to cash. That means they can be converted literally right away to cash. There's also some additional characteristics they have to have. They have to be short term. In other words, they cannot have, if they have a maturity date, the maturity date has to be 90 days or less. And it's important to note, and this was where people make mistakes, the security itself cannot have a maturity period exceeding 90 days from the date of the security's inception, which means if you have a security that says it has a 180-day maturity date and you're in the last 30 days of that 180-day maturity date, you still can't classify that as a cash or cash equivalent. Also, that security must be easily converted to a known amount of cash. Also, it has to be a minimal risk of change in investment value. So in order to be considered a cash equivalent, the short-term type of securities have to meet these criteria. Now, items not classified as cash and cash equivalents, these are also considerations on the exam. Start off with the miscellaneous items first. First of all, post-dated checks. Post-dated checks are checks that basically, in theory, you may have it, but it's been post-dated, which means it's dated in the future. So you can't really cash it. The bank won't theoretically honor it. So if you receive a post-dated check, you can't include that as cash. That has to be retreated as basically when you receive it as a receivable because you're going to collect it sometime in the future. NSF check, that's non-sufficient fund check. That's when for whatever reason, the client or whoever paid you didn't have enough money in the account and the bank returns the check. Okay, when the bank returns the check, the money that you originally counted in your checking account has to be reversed out of your checking account. And typically most companies would then call that check a receivable because now that individual didn't pay off their debt, they still owe us money. Another thing that is considered sometimes in cash and cash equivalents is when we create an overdraft in our checking account. Many banks allow companies to either, well, basically to overdraw their checking account, so their checking account ends up with a negative balance. Under those conditions, we need to reclassify that overdraft as a current liability unless we have funds to cover that in the same bank, in other bank accounts in the same bank. Then we don't have to classify it as a current liability. If the overdraft is in a bank where we don't have any funds to cover it in other accounts, we have to classify that as a current liability. Now again, investments basically are not considered cash and cash equivalents when there are substantial restrictions as to their liquidity. And that can even occur in short-term investments, typically again in money market where or CDs where you have to give 30 days or 60 days notice on a withdrawal or whatever. There's restrictions. Uh, those would be classified typically not as a cash and a cash equivalent. They'd either be classified as an investment as current or a non-current asset. Now, cash and cash equivalents on the balance sheet, again, typically they are listed as current if access to the cash and cash equivalents is available within the current year or the operating cycle, whichever is longer. Typically, it's a current year, and we typically use that as the operating cycle. Non-current if the access is not available within the current year. Now, we're going to talk a few minutes about bank statements and bank reconciliations and company financial records. The reason I talk about this is these are also a good testing area on the CPA exam, either as theoretical questions or they're really excellent. They're really excellent for simulations. Again, to remind you about banks and bank reconciliations, if we take a look at our basically, when we have a checking account with the bank, we actually basically have created two mirror accounts. We have our company financial records where we keep our general ledger records. So every time we make a deposit, we add to that. We debit that account. Every time we write a check, we credit that account, that cash account. So we're debiting and crediting for all our activities. So what we see is when we create, basically we record deposits, in other words, deposits that we're making based upon the checks that have been written to us and other cash we're receiving. Also, checks written when we write a check to a to a vendor or to a creditor. We record that in our company financial records in our checking account, ledger account. Also, we record bank charges or miscellaneous type of adjustments that could be even correcting errors that we may have made or the bank has made. Interestingly enough, though, that everything that we do in our company checking account is mirrored in the bank statement. In other words, when we record a deposit in our company checking account, that deposit will be recorded in our bank records. When we write a check, that check will eventually be presented to the bank for cashing, so that basically it'll provide a mirror record of checks cashed. Bank charges, typically the bank makes some bank charges against us, and then we end up recording them in our company records, and the bank could have miscellaneous adjustments again or error corrections. So basically whatever happens in our company records should happen in the bank statement. Whatever flows through the bank statement should appear in our company records or be adjusted. So when you think about this, a bank account reconciliation is an extremely powerful control because both the company financial records and the bank statements have to record the same things. Now, if you also remember that cash is a very, very desirable asset. As a matter of fact, it's probably the most desirable because it's cash. And it's easy, there are ways you can take cash or transfer cash and so forth. That's why it's critical. It's a critical internal control that a company reconcile their bank statement back to their company financial records as quickly as they can when they receive their bank statement. Now, in reality, unfortunately, though, when we record something it may take some time for the bank to also record it, because a deposit, let's say, that we make today, we send that deposit to the bank. It may not get recorded to the next day or the day after. Checks that we write today may not be presented to the bank until weeks after they've been written. In the case of bank charges, a bank may charge us for things that we're not aware of, that we're not going to be able to record on our books until we see the bank charges. So that's why we perform a bank reconciliation, because in reality, the company financial records never agree to the bank statement. We have to understand why those differences have occurred. And again, the CPA exam likes to test these differences, whether it be a bank reconciliation or what you should include in your company financial records for cash and cash equivalents and so forth. What I've done is I've created a matrix that basically classifies all the major differences between our company financial records and our bank statements, and what you would normally do to either the bank balance or company books. The key to a bank reconciliation is to make the proper adjustments to your bank balance and also your company books. So by the time the bank reconciliation is done, we have a reconciled balance per bank and a reconciled balance for company books, and those balances should agree to each other based upon the reconciliation. So with that in mind, now let's go over the next three. We're going to do three multiple choice questions regarding cash and cash equivalents. So again, this is similar to your other review videos. When you go ahead, review the question, stop the video, and then arrive at what you feel is your correct answer. And when you believe you have the correct answer, go ahead and restart the video and review the solution. So let's take a look at question number one. Okay, now this company has four separate balances in their general ledger, and what you have are facts about cash being in checking accounts, cash on hand, certain restricted cash, and so forth. And what you need to do is, the problem is asking you, what should Keno report as cash, which would be cash and cash equivalents, at the end of year one. So go ahead and stop your video, and when you're ready, restart the video and review the answer. Okay, number one, the answer is B, $3,050,000. So let's go through these three items here. We had cash in a checking account for $3 million. Okay, now we're going to include that as cash, and this is what's confusing to people. Even though a compensating balance exists, okay, Keno is not contractually restricted to not using the compensating balance. If the compensating balance is used, Keno's going to have to pay a little bit higher rate, but they're not restricted to that. Okay, number two then, cash on hand, and that should read, let's take a look at number one. And we're given a number of facts, or we're given information regarding bank accounts with Keno Temple Corporation. And the question is, what should Keno report as cash, in effect cash and cash equivalents, at the end of year one? So go ahead and stop the video, read the question. Let's start off with question number one. This company here, Keno Temple, has the following four separate account balances in their general ledger, and you're given some facts regarding the account balances, debt covenants, and some compensating balance information. And the question asks, what should Keno report as cash at the end of year one? So go ahead now and stop your video, and when you're ready, with your answer. Go ahead and restart. Okay, number one, the answer is B, $3,050,000. So let's take a look at the individual pieces of information here. Okay, we had a cash in our checking account of $3 million, and we're going to include as cash and cash equivalents, even though a compensating balance exists. Keno's not contractually restricted to not using that compensating balance. As a matter of fact, they can use it. They just have to pay an additional premium on their borrowing rate. So that would be cash and cash equivalents. Cash equivalent. Number two, cash on hand. We'd add $50,000. Would be include that as cash. Number three then is cash restricted by debt covenant to pay off long-term bonds of $2.5 million, which will be paid off in year 10. Okay, in this case, that is a restricted fund. Do not include that as cash. Cash restricted by a debt covenant to pay off a long-term bond basically is not part of cash and cash equivalents. It will be listed though as a non-current restricted investment, but it will not be listed as cash and cash equivalents. So that's the answer for number one. Let's take a look now at number two. And again, we're given a company with, the company has received some checks and has written a check or two. And based upon some timing difference, there's a question as to whether items should be included in Cane Gardens Bay's cash on the balance sheet, cash and cash equivalents on the balance sheet. So the question is, what should Cane Garden Bay report as cash on the balance sheet at the end of year 5? So again, stop your video. Okay, the answer in this case would be A, $4,800. And let's look at the individual items here, the 3 bullet points. Okay, number one, we have a check payable to Cane Garden Bay. It's dated January 2nd of year 6, but we're trying to find the balance at the end of year 5, and the balance we showed was $5,000. Now, the amount that we included was basically, we do not include that in cash. It's a post-dated check, so basically we don't include that in cash. Okay, number two, check payable to Cane Garden Bay for $500. Now, it was deposited in the bank and it was recorded as a receipt. In other words, a deposit in the accounting records as of the middle of December in year 5. And the check was returned to Cane Garden as non-sufficient funds on December 27th. So we don't include that item in cash. The check should be recorded as a receivable. Now we have to remember it's already on the books in cash, so we have to subtract it from our book balance. Item number 3 then is a check for $300 drawn on Cane Garden's account. In other words, Cane Garden's paying a bill, dated and recorded on Cane's books, but will not be mailed until January the 2nd. So in this case, what happens was that amount was subtracted from their checkbook balance, but we need to include that in cash because the check is not out of the control of the payer, Cane Garden Bay, until it's been mailed on January the 2nd. So that's the answer to question number 2. Let's take a look now at question number 3. Question number 3 basically asks, what should Rangoon report as cash on the balance sheet at the end of year 8? So we have 3 different facts. So what should be reported? Go ahead and stop your video. Okay, the answer to number 3 is B, $13,800. Remember that the checkbook balance should represent the balance in the cash account for the company. So number 1, we don't even care about the bank statement balance. That's just extraneous information. The check written to Acme was recorded on the company's books, but again, the company's still in control of the check. Therefore, the $1,800 should be added back to the company's balance sheet for that end of year balance, the $1,800. And that's the answer to number three. So thank you for your time, and that's the end of cash and cash equivalents.